Another important factor to consider when you're taking out a loan is what is the value of that loan to the borrower, right? Are you getting a good interest rate or not? And if you are getting a good interest rate, how much is that worth to you today? Right, this is where present value or net present value analysis comes in, and we can start to think about what is the value of getting a good interest rate on your mortgage to a borrower. All right, so to build this idea in, we're going to need a new parameter here, and that's the discount rate. Right, we have an interest rate up here at the top, right? Our annual interest rate is what we're being charged by the bank. Our discount rate, now that's a little bit different concept. Here, the discount rate we want to think about is kind of the fair market rate for borrowing money. All right, so if we thought about, you could go to Yahoo Finance, Google Finance, any of these websites and look up what 20-year interest rates are. Right, typically you're going to see Treasury yields, right? What are U.S. Treasury debt trading at on a 20-year term? You might see corporate debt yields, but at the end of the day, that's not necessarily going to apply to us as consumers, right? So if you dig a little deeper, you can go look at mortgage interest rates, right? You can look at the average mortgage interest rate across the country on 20-year loans, right? If that's the average kind of prevailing rate across the country, that seems like a pretty good thing to use kind of as our discount rate, right? You might get a better rate than that, though. Shopping around for mortgages is a real thing that can save you a lot of money. And if you can shop around and save, say, 25 basis points or even 50 basis points off of that kind of average national rate, then that could save you a lot of money. And here in this model, we want to see exactly how much that can save you. So the way we're going to build this out is, as we've done in the past, build out discount factors, right? And we're going to calculate the present value of our payments. So our discount factor here, well, the same as we've done it in the past, 1 divided by 1 plus r. In this case, our 4% adjusted to monthly divided by 12, raised to the number of months. All right, that's going to kind of be our easiest way to do it. Once we get our discount factor, we can just multiply our discount factor times the payment, and that's the present value of that payment you make, right? You make a payment for $1,211.96 at the end of the first month. At time zero value, that's worth $1,207.93. So now we can map this out all the way across our model. All right, let's go ahead and go down to make sure it's working. Whoops. All right, here we made a little mistake. I wrote the formula without thinking about the fact that I don't want it to show values once we get past this start. Why is this going to be important for us? All right, well, one thing we're going to be interested in is calculating the present value of payments. So if I calculate the present value of all these payments, again, doing the entire column to make sure that my model can be dynamic and change with the term, now I'm going to have a value error. So I really have to deal with this problem. The way I can deal with it, though, is the same way I've dealt with the other problems. Right? We can come in here and use our isNumber function. So again, we have our if isNumber. Again, we're just checking if that month is a number, so we'll put that in here. Let's do it first for our discount factor. We'll do it second for our present value calculation. We'll copy both of those cells first up, and then all the way down. If we go to the bottom, we see we no longer have those value errors down here. And eventually we get back up. There's where our loan ends at month 240. All right, notice that that $1,211 payment is now in present value terms only worth $545 when it's 20 years out. All right, so let's go back and now let's check out our present value of payments. Well, it's equal to $200,000, right? We've seen this number before. Why is it equal to $200,000? Well, because the annual interest rate that we're paying is 4%, and the discount rate, or the cost of capital to mortgage borrowers, is 4%. So in that case, we're discounting at exactly the same rate we're paying the interest, and so the NPV is going to be 0. All right, the NPV is 0 from the perspective of the borrower because what they're getting is $200,000. What they're paying, right, what the cost is all those payments over time. So if we calculate the difference, $0, which makes sense. We're discounting at the same rate they're making payments. So now where the interesting question comes in is, what if you can negotiate a better rate? Right? If you shop around and instead of getting 4%, you get 3.75%, what happens? Well, our interest rates go down, our interest payments go down, and our present value of payments did not change here. So let's check out what happened. So notice that I was actually pretty sloppy in how I built the model initially. Right? Instead of selecting my discount rate, I selected my annual interest rate, which worked out in the prior example because they were the same. Now let's go ahead and update this. Right? We expected a change. Let me redirect it, copy it down, and now we get what I was hoping for. Right? We see that the present value of the payments is only $195,000. So what that means is, as a borrower, you got $200,000 today to go buy your house, and the payments that you made back over time were at a 3.75% interest rate rather than a fair rate, or kind of that average market rate of 4%. So you were saving a little bit every month. What was that worth to you? About $4,300 in present value terms. So what that tells us is, if you can shop around, spend an extra hour or two shopping around for better mortgage rates, now you can save yourself $4,000 in present value terms. What if instead you save 50 basis points? Now we're talking about $8,000 in the present value of savings. So there are big savings to be had by shopping around for better interest rates, particularly when we're talking about borrowing sums of money like $200,000. Right? If instead you're buying a much bigger house and you have $500,000 here, now that's worth $21,000 to us. So shopping around can really pay when you're getting your interest rates, when you're buying your first home, or even when you're refinancing your home in the future. So always take a little bit of extra time to make a few phone calls and go and try to find the lowest interest rate you can for your mortgages, for car loan purchases, student loan refinancing. So there are lots of opportunities to try to find better interest rates out there, and the savings can really add up over